With the sharp moves in commodity prices over the last few days, it is no surprise that markets are pricing in increasing risks of stagflation, a rare combination of high inflation and recession. But what does this mean for the economy and how will central banks deal with it? Joining me now is Marc Ostwald, Chief Economist and Global Strategist at ADM Investor Services. Marc, welcome. Let's kick it off first with a little bit of data, because with everything that's been happening in global markets right now, data seems to have been pushed a bit to the back of the line and people potentially not paying as much attention as other times in markets. Do you think tomorrow's CPI data, US inflation data, might very well be one of the most watched out data points in the last few years?
I think it would have been, were it not for the current situation. The current situation means that what we're getting a picture of tomorrow is a baseline for where we might go from here. The assumption had generally been before the war in Ukraine, that we would probably get to a peak in February. This would be peak inflation, and from here, the base effects in energy prices and other commodity prices would start to unwind, and we would get back to some sort of place which is rather more normal. Now, instead, it provides us with a baseline of a very poor starting point from which we will only climb higher, and the peak will be seen much, much later in the year. So it's significant in that to that extent, but it's not a situation, obviously, which anyone really is under any control of, as we heard from OPEC yesterday. They can't control energy prices at the moment. It's a function of the situation.
Yeah, I mean, you were talking there about it being a baseline rather than the peak as potentially people were expecting in February. If we try and break down the data point a little bit, what weight does this surge in energy prices have in the CPI data? To what extent are we expecting the damage to be shown? Because we know that in manufacturing and distribution and day-to-day running of households, we will see this increase in energy prices materialize, but that's potentially further down the line. And in February, expectations are for a 7.9% year-on-year rise, with core expectations at 5.9. So we are seeing that 2% difference in core and baseline readings. To what extent will this actually materialize in the next few months or so? Or is it potentially something that will bypass the data?
Well, I think the important part about the CPI data tomorrow, it'll show a couple of things. First of all, there's enormous pressure from housing. It's not just energy. There's also considerable pressure from food, and that's not even including anything that's happened with, for instance, wheat prices in recent days. So it underlines that the pressures that are there, energy clearly is at the core of all of this, but it is also, we are also talking about other non-discretionary inflationary pressures. And that's really the biggest challenge here, because it's demand side driven, rather supply side driven. So it's supply chains and the prospect of key supplies, above all in food and energy, being cut off and having to be sourced from elsewhere going forward. For the United States, probably, and North America in general, not nearly as much of a problem as for Europe. Or indeed parts of Asia. But it really underlines that, we are probably at the point where we're starting to see trickle-down effects. Companies simply, companies have absorbed a lot of the price input price pressures over the past couple of years during the pandemic. But now particularly given what's happened over the last 2 weeks, we're in a situation where no one's in the position to do that unless they want to go out of business. And in a lot of cases, it may still mean that there are people who go out of business. Agricultural sector, I spoke at the conference just last week, is in a nightmare scenario for livestock, simply because their feed prices going up into the sky, while the prices of cattle and pork, particularly pork, are actually flatlining or going down. And so what's the viable business model? So the inflation picture here really tells us just how much pressure there is on households and how much pressure on businesses as we then start to look at the impact of what's happening now in commodity markets.
Yeah, let's talk now about central banks, because we do have a busy few days ahead. We've got the ECB tomorrow on Thursday, and then we've got the Fed and the Bank of England next week. Now, if we do see inflation continue to remain robust as we are expecting it to do, we've pretty much got two scenarios for any central bank, but let's potentially focus on the Fed because of this US CPI tomorrow. We could either see the Fed increase their rate hiking to 2% quite quickly to combat inflation, but potentially hinder growth, or we could see them kind of take it slowly with rate hikes and just make sure that growth is stable and potentially lose credibility with fighting inflation. I feel like it's just a case of how much does the central banks have to allow external geopolitical surprises to kind of derail them or blow them off course of their monetary policy. What's the right thing to do here? I mean, stagflation is the word that's been going around. It has been for a few months, but I feel like now with everything that's going on, it's definitely back on everyone's mind. It's hard to say what they're going to do.
Yes, stagflation talk is definitely going to keep on doing the rounds. When you get a 50% deviation from trend in oil prices, there's been no situation over the past 50 years since the first oil crisis in the early 1970s where that hasn't led to recession. So it's very natural that we are talking about a stagflationary environment. How do central banks react to this? Well, to be very honest, they're damned if they do and damned if they don't. Part of the problem obviously lies in the fact that they've been very slow. They've misjudged the inflationary pressures. Leaving aside what's happening now, they misjudged the inflationary pressures that were there beforehand, largely because they misjudged the whole situation in terms of supply chains. The supply chain problems are only going to get worse. Is there anything that hiking interest rates can do to alter that supply chain dynamic? The answer very simply to that is no. This is a point where we have believed in the so-called omniscience and omnipotence of central banks around the world, above all the Federal Reserve and the ECB, to basically manage the world's economies while politicians have been largely sitting on the sidelines and letting the central banks take the strain. Obviously, that changed very much during the pandemic. We had a lot of fiscal stimulus. And the key point here is there's two things really that central banks are going to need to look at. They need to realize that actually they can do nothing about the supply side. The second part is they need to also support the fiscal side, because it is the fiscal and political side which can deal which has the wherewithal to a certain extent to deal with the supply chain bottlenecks, to deal with very rapidly changing trade flows, even more so now that we've declared economic war. And thirdly, the central banks are above all needing to focus on financial conditions. And indeed what the ECB calls financing conditions. They are two different things. Financial conditions, as measured by indices, are mainly a function or a reflection of what's going on in markets, above all driven by volatility, credit spreads, money market spreads, all of which are going in the wrong direction at the current time and are likely to remain elevated, i.e. we are likely to see credit spreads widen, money market spreads show some signs of dislocation and difficulties in refinancing positions, and volatility is definitely going to remain high simply because the situation is very opaque. We don't know what's going to happen. We will tend naturally to hope for the best. The question then is, how much does the extant volume of central bank liquidity actually lean too heavily to hoping for the best and not preparing for the worst? I think that's the big difficulty that central banks have to judge at the moment.
So in your opinion, quickly, do you think tomorrow's US CPI data will influence at all the decision of the Fed, whether to go 25 or 50 basis points? That's been the talk on social media definitely recently.
I think 50 basis points is simply off the table for the current time. They want to be seen to be doing something while not setting a benchmark for being aggressive going forward, given the uncertainty.
Okay, and I just want to quickly finish off with talking about oil prices, because they are the talk of the town at the moment. And potentially the talk about oil prices, or this rapid rise in oil prices, being a disinflationary pressure. Because if you think about it in the short term, yes, they are pushing prices, but it's potentially reducing the expenditure of households, the capacity of households to spend in other areas, and potentially saying that the need or the case for rate hikes when oil is at current prices is potentially a little less than when oil prices were at $80 per barrel. So say, what's your opinion on that?
Well, I think with oil prices, the biggest problem, we're looking at disruption, and we're also looking at extraordinarily tight oil markets. So tight, that tight oil market supply situation is only made worse. Can central banks do anything about it? No. Oil prices are, well, energy prices, because this isn't just about oil prices. It's also, crude oil prices. It's also about oil product prices. We've got refining problems because there's a lot of capacity being lost. So they are going to remain elevated. My problem here is we've got a situation where, for instance, say we got into a situation where there was some sort of diplomatic resolution to this. We're still going to have a lot of the disruption in place, but the potential for, after this parabolic move in oil prices, for a huge correction is enormous. I mean, what do we do? And how do central banks then react? And then on the follow, what is the consideration when we actually find out, oh, great, we've got peace, but we've still got all these supply chain disruptions, and we've still got, above all, supply problems within the oil market. And we definitely need oil, regardless of however much transition pressure there is as a result of everything. It's still a problem. So you've still got a situation where oil prices, I have no idea. Could they fall $40 or $50 in the event of peace? They could do. Quite possibly. It really depends how badly people get caught in positioning terms. Could they rise then very rapidly again? Absolutely. So you're in this situation where we're going to see some demand destruction. There's no question about it. Both for businesses basically trying to curtail some of their energy use to basically keep their costs under control, and from consumers who are facing pressures on all sides: food, oil, food, energy, and housing. So the extent of that demand destruction really remains to be seen. The only thing one can say is that post-pandemic, or now that we're in an endemic rather than a pandemic, there is still a lot of underlying pent-up demand.
Well, thank you very much for joining me, Marc, and for sharing your views. That was Marc Ostwald, Chief Economist and Global Strategist at ADM Investor Services. For more videos from us here at IGTV, join us on Twitter at IGCom, Instagram, and subscribe to our YouTube channel.